Hello everyone, hi, welcome to the channel of Wall Street Mojo. Today we have a topic with us is called imputed interest. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Now, what exactly is imputed interest? The first and the foremost that we'll start with some of the intro part. We'll do some intro on this. See, what happens when you lend money to your family, friends, colleague? Okay, mind, you are not talking about something that's called 1000 bucks for a weekend, but a sizable amount might be used by the borrower to infuse money into the business or education loan, or to maybe buy a car, or simple as the personal loan. So you did lend and did not charge any interest, as you lend the money in the good faith. So you, being a perfect friend, are only concerned about the principal, which you did get after some time as promised by your friend. Now, although it looks like an in-house transaction between you and your friend, there is more to the story as far as these tax authorities are concerned. So even if we ignore the credit risk part, that is the credit risk that is involved, there can be a huge tax penalties that might come as a shock in your tax calculation sheet. Sounds confusing, right? Okay, we'll go with first is, what is imputed interest? See, the concept of the imputed interest refers to the calculation of the interest that should have been paid for the tax calculation, even if there was no actual interest payments between the lender and the borrower. Hence, the name imputed or implicit, the imputed interest serves as an instrument for the tax authorities to collect the tax revenues on loans and securities which either pay or no interest or very little of interest. Now, how this imputed interest exactly works? Well, coming back to our example where you lend money to your friend, you might not have charged any interest, but IT department assumes the interest accrued on the principal as your income, and hence it calculates tax on which it eventually adds up to your final tax state. Now, what exactly is the reason for such implicit tax? Well, if it came to the notice of the tax authorities that might have high bracket taxpayers was shifting their income to low bracket relatives or reference. So doing so, the authorities believe this is a high bracket taxpayers were evading tax, and this is because in an ideal scenario there would have been taxes on the interest which income tax department is losing out to because of the absence of the structured loan mechanism. So there was a considerable increase in such instances, which led Congress to enforce, such new laws, that recognize imputed interest as income. So the first such law that came through the act was in 1984. Now, for example, let's say a couple provides a principal amount of 1 million to the child as a loan to buy a new house without charging any interest on it. So also it has been decided that the child can pay back the amount within what we call as 8 years. Okay, to avoid any sort of burden on his current financial state. So the generous situation might not be sensible for the couple, as it might not bring any interest payment, because they could have earned an interest income if they would have lent out the money third party. Now in this scenario, the IRS would assume that the parent company would have collected an annual interest payment of, let's say, 5% a year, which would be added to their interest and the income in the tax return calculation. Okay, so hence in this scenario, $50,000 will be added as the interest income in the IT returns sheet for the couple, even though not a single penny was paid by the child explicit. Now, the concept of the imputed interest also applies in some of the scenarios like, zero coupon bonds, where the investor does not receive any fixed annual interest payments, but the bond itself has been purchased at a discount to its face value, and the difference between the discount price and the maturity value represents the interest the investor has actually earned, okay, during the tenure of the bond. So in simple terms, the tax on the imputed interest will be calculated even if the investor has not at all, even if he has not received any yearly payments. That's fine. Now, the corporate lending money to the shareholders, for corporates, this will be an interest income, right? And for the shareholder, so it will be divided income. Now, all the financial instruments such as loans that might have a favorable interest terms and significantly reduces the tax liability of borrower or lender. Now, Intrafamily loans that generate unrealistic tax implications, gifts loan, demand loans, compensation related loans, employer to employee loans, and this will be related as compensations income in the employee tax returns. So why knowing the imputed tax or the imputed tax in return is helpful? See, the imputed interest comes into picture when a loan has been given interest free or very low interest rates. So the IRS, they publishes this imputed tax rates monthly, and imputed interest tax rates, they remove any incentives to exploit in-house loan transfers and evade the tax exploitations by the high brackets taxpayer. Knowing the imputed interest rates would be helpful in planning your investments better and would avoid any unpleasant surprise to your annual tax filings. Now, what are the best ways? Okay, my question is, what are the best way to avoid any tax implication? Okay, so first we would understand, no financial loan is interest free. There is always an imputed interest, however small it may be. And a loan of even $10,000 should not pose any problem on either part. But make sure that that the limit applies when you have multiple of such loans in 10,000 is not a threshold for one such individual. Now, before indulging any such transaction, have an official contract properly documented where you and your other party agree on the loan tenure, fix imputed interest rates, and the mode of the payment. This will make sure that both the lenders and the borrowers are aware of the tax implications, repayment terms, legal proof, and in case of any issue, articles with the tax authorities. So this should avoid any last minute adversities or adverse tax consequences. The other important factors to be considered here is that the loan principal should be what we call as reasonable. There should be reasonability considering the financial situation of the borrower and should not raise any such suspicions. Now, intent to pay and repayment schedule should be evident in the legal contract. Now, borrowing from such someone might be better way of financing, as it is, the Fed government sets the imputed interest rates far below the market lending rate. So, however, do remember that there is no free lunch, and misunderstandingly or overlooking of the same can result hidden tax penalties to your generous lenders. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.